Good morning and welcome to Chapter 12. We are starting with some real world stuff that you need to know as functional adults in our society. We're talking about the tax system. So, where does tax revenue come from in the United States? What does it cost us to tax our population? How can we evaluate the equity of the tax system? And here, equity is used somewhat in the sense of fairness. So, we learned in Chapter 1 that sometimes the government's involvement can improve market outcomes. We've talked about public goods, regulation of common resources, ways of inhibiting the influence of externalities. Doing all of those things costs the government money. And so the government has to get that money from somewhere, and it does so through taxing people. We know that a tax reduces the market quantity of that good. Remember from a few chapters ago, I think chapter 8. We know that buyers and sellers share a tax differently depending upon the price elasticity of demand or the price elasticity of supply. And we know, of course, that a tax provides us with our favorite pro wrestler, DWL, Mr. Dead Weight Loss. So when we look at the tax system of the United States, you have to recognize that it is not typical of global taxation systems. It has evolved over a long period of time. So we're going to look at how tax revenue as part of national income has increased or decreased over time. We're going to look at our taxation levels of our population versus those of other nations. And we're going to look at what is different in terms of revenue sources between the federal government, the state government, and local governments. And so let's take a look at that first. When we look at the total tax burden on the U.S. population, that's the blue line, we look back to pre-Great Depression, and it was about 10% of the government's total income was tax income from the people. Now it runs about 30% of the federal budget. And look there before World War I, notice that the state and local line, the green line, actually was at a higher rate than that of the federal government. And that's because things were simply done differently. In reaction to the Great Depression, the New Deal was implemented, and that resulted in increased federal spending. However, you can see that the federal spending still did not exceed state and local until we began to prepare for World War I. And then the World War I ended. We tried to reduce spending. You can see the downward spike there between 45 and 50. You get the Korean War, then the Cold War was fought, and then you can see as approaching 2000 how the federal tax receipts have decreased. Now, those haven't necessarily decreased as a result of action on the part of the federal government. They are more evincive of the recession and the fact that we have more people unemployed, we have lower incomes, and so the tax receipts from those sources are lower. Let's look at how we stack up against the rest of the world. That's us right in about the middle at 28% of GDP. That's our government tax revenue. When you look at Sweden, France, United Kingdom, those are very high tax nations, but they do different things for their population than we do. We have a more privately based healthcare system. Theirs is much more public, bordering on what many folks would call socialistic, where everyone is covered. And that costs a lot of money, and that is why those nations have those tax systems. And then when you get down towards the bottom, you look at a lot of less developed nations, India, China, Chile, even Mexico. And they have much lower tax rates because they have not yet evolved to a point where the people are expecting the provision of services on the same level. So breaking down these numbers, and this is from 2010, still going to be recession era numbers. We were right in the heart of the recession in 2010. So you look at individual income taxes, the amount per person about $2,900, totaled almost 37% of the government's total tax receipts. Social insurance taxes, that's Social Security, Medicare, Medicaid, things that go to those social insurance programs. Most people are generally surprised to know that those tax receipts are actually higher than the personal income tax receipts. Then corporate income taxes. And this is going to come up later, but I'll point out that corporate income taxes, in many people's views, are actually taxed. Corporate income is actually taxed twice because the corporation pays taxes on it, and then you, as a shareholder, when you receive dividends from the corporation, those count as part of your income, and you as an individual are then taxed on those. And then other taxes come from what are known as excise taxes. That's taxes on gas, cigarettes, luxury goods, those kinds of things. So then when you look at the state and local level, it's a much different story. Remember, at the federal level, the majority of income, or majority of tax receipts were income and social insurance based. And at the state and local level, sales taxes and property taxes make up the majority of the tax receipts. Individual income taxes, this is a generalized number for all 50 states, but there are a number of states that do not even have income taxes. So take that somewhat with a grain of salt. And then corporate income taxes, which are often adjusted by states and localities to try and serve as business incentives, and those vary over time. Okay, taxation absolutely affects the efficiency of our market system. The way to determine whether a tax system is more efficient than another is to look and see, can I inflict the same cost on taxpayers and yet get more revenue? If the answer is yes, then that tax system is more efficient. When you say, well, what are the costs? Well, obviously, the tax itself is a cost. And then what's another one? I hope you brought our favorite wrestler up again. Deadweight loss is a huge cost to taxpayers. And then this one is one that often gets overlooked by taxpayers. It's the administrative burden. This is the cost of running the IRS and the taxpayers' time going through their receipts and figuring their taxes and driving to H&R Block and paying their accountant to calculate their taxes. All of that is part of the cost to taxpayers in terms of our taxation system. So, deadweight loss, breaking it down. People respond to incentives. We know that taxes distort incentives. They're going to get people to allocate their resources based on tax incentives rather than the real costs and benefits. And that can really mess up our system by creating an unnecessary level of deadweight loss. And that is where the decrease in taxpayers' well-being is going to exceed the revenue that the government collects, meaning taxpayers are worse off than the government is better off. And that is something we really want to avoid creating. Okay, there are different ways to set up taxation systems. In the United States, we have an income tax at the federal level that is based on the amount of income you as an individual receive. There are folks who say that a consumption tax would increase our efficiency. A consumption tax is literally a tax on the items you consume. So let's walk through this. The income tax truly reduces your incentive to save money. And here's how it works. Okay, let's just say that your income tax rate is 25% flat. Okay, and the savings interest rate is 8%. 25% of that interest rate is going to be 25% of the interest that you receive off of your savings is going to be taxed, which means that you essentially have a 6% interest rate. So that lost income compounds over time. And if you have not read the chapter, you have got to get in there and read the section about how deeply consumption impacts the incentive to save. So there are economists that say this is really bad. People don't save enough because we are taking a chunk of their incentive to save. And so they say if we did a consumption tax, it would restore the incentive to save. It might even increase incentive for saving. It would encourage investment. People would do a better job of saving and providing for themselves in their retirement. And in the long run, what they're saving and investing in is going to result in economic growth. And we're going to be better off. There are aspects of a consumption tax that exist in our tax system already. If you've heard of a 401k plan, where you can put some of your income into an account, and then does not count as part of your income now. You don't pay tax on it now, but you'll pay tax on it when you withdraw it. Though contributions to 401k plans and what are known as Roth IRA plans and IRA plans, individual retirement account plans, those are limited by the federal government so that people don't take too much advantage of the tax breaks. So when you put that money in, then it's taxed when you withdraw it. And the philosophy here is I'm a young professional. I'm kind of in the middle of my career at 35 or 40. I'm earning $100,000 and I want to decrease my tax incidence right now and prepare for retirement. So I'm going to sock that money away into my 401k. When I retire and withdraw that money and pay taxes on it, my income is not going to be anywhere near $100,000, and so the tax rate that I pay on those withdrawals will be much lower. There's where your incentive is. So if you're wondering if a consumption tax really works, the value-added tax, or what's known as the VAT tax, if any of you have traveled to Europe and bought anything, that is very similar to a consumption tax. What the value-added tax does is it taxes producers at each step of production along the way. So when I buy flour, it's taxed. When I sell my raw cookie dough, it's taxed. And then the factory that bakes those cookies sells the cookies, those are taxed. And each value that is added along the way gets taxed rather than taxing it at the point of purchase. Okay, breaking down administrative burden. Like I explained earlier, this is the time and money that you spend making sure that you're not breaking the tax laws, and the tax code is immense. If any of you are thinking about being accountants and thinking about tax accounting, understand you've got a lot of reading to do. The fact that this is so high and that our tax burden is so high encourages people to spend money trying to find the loopholes in the tax code and ways around spending on taxes. That does produce a lot of employment for accountants, but in the end, it's money spent to avoid paying taxes that would ultimately be returned to society. It is a type of deadweight loss. We could reduce a lot of the administrative burden if we simplified the tax code, but the question is, why don't we? Why is the tax code thousands of pages long? And the answer is because of lobbyists in our political system. Those loopholes are in there for a reason. They didn't happen by accident. Many of them were put in intentionally by lawmakers, and to get them removed would be a little tricky. And especially since every 2 years we face an election year, and lawmakers need money to run for re-election. Okay. There is a lot of detail up to this point that I have left out. You have to read this chapter, period. If you have not begun, you have some homework to do. Okay, the average tax rate is the total taxes paid divided by your total income. It measures your total sacrifice as a taxpayer. We also look at marginal tax rate, and that is the tax rate on an additional dollar of income, or some economists will say the tax paid on the last dollar earned. The marginal tax rate measures the incentive effects of taxes on work effort, saving, all kinds of stuff. Let's break this down a little bit, okay? If we had lump sum taxes, they would be the same for every person. Warren Buffett pays the same amount that your mom pays and the same amount that your grandma pays, okay? If we had a lump sum tax rate, let's say $4,000 a person, everybody kicks in their $4,000, okay? If grandma is earning $20,000, her average tax rate is going to be what? So you take the $20,000, you divide it by the $4,000, the average tax rate is 20%. If grandma were to earn $20,001, would she pay more tax? The answer is no, she would not pay any more tax. She's paid her $4,000. So what is her marginal tax rate? You should have said 0. Now let's take, me. I earn $40,000. I'm going to pay $4,000 in taxes, so what is my tax rate? Just a little decimal work here, 10%. If I work a volleyball game and I earn $40,001, what is my tax on that last dollar I earned? Your answer should be 0. You've already paid your $4,000 in taxes. So that's what a lump sum tax would do to the marginal tax rate. Now, here's a fascinating tidbit. Lump sum taxes are the most efficient tax. If we were going for optimal efficiency, we would go for lump sum taxes. There's no deadweight loss, no distortion of incentives. All I have to do is write the check for the amount the government tells me. I don't have to hire an accountant. I don't have to track receipts. I don't have to look for deductible ways to invest my money. A lump sum tax, however, is seen as very unfair. For instance, grandma was paying 20% of her income in taxes, and I was only paying 10%, and that's not fair to grandma. She doesn't have that kind of money. So the poor end up paying as much as the rich, and relative to income, the poor pay way more than the rich. And I said relative to income. As a percentage of their income, they pay way, way, way more. So remember, one of our goals wasn't just efficiency. One of our goals is equity. So the lump sum tax model fails on the equity test. We want to make sure that people are taxed fairly. And fairly is a very subjective word, but I think we can agree that grandma paying 20% of her income and Warren Buffett paying 1% of his income isn't exactly fair. However, it is difficult to agree on what is fair. Efficiency we can put a number on. Fairness is much, much, much more subjective. But there are some principles that we use when we try to decide, is this tax system equitable? The first principle we want to look at is the benefits principle, meaning I should pay based on what I receive. Okay? I should have to pay based on what I am getting or what I am going to get back. And the basis here is that they're trying to make public goods a lot more like private goods, meaning the more you use, the more you pay. A good, solid example of this would be the gas tax. The more gas I buy, the more gas tax I pay. This is related to how much I'm using the public roads. And so the taxes on gas go into the government kitty to help pay for maintenance of the public roads. And so as I'm using more public roads, I'm paying more of the tax. And so that would meet the benefits principle. We also operate somewhat on the ability to pay principle. And this means we should each pay according to our ability. This is based somewhat on the concept of an equal sacrifice, an equal share, even though that equal amount isn't an equal dollar amount, it's an equal burden. It recognizes that it isn't dependent just on the dollar amount of the check that you write to Uncle Sam, but based on your actual ability to pay. If I am earning $20,000 a year, this is Grandma, and she's adopted 2 of her grandchildren, her ability to pay is considerably less, and so under the ability to pay principle, her tax burden would be much lower. And so to put numbers on it, a $10,000 tax bill is a huge sacrifice for Grandma, and not so much for Warren Buffett. There's another concept that is known as vertical equity. And the vertical equity system is where Warren Buffett would pay a whole lot of money and Grandma would pay very little. Basically saying the people who can should pay more, and the people who can't shouldn't have to pay more. All of these considerations leave us with 3 tax systems. There is a lot of vocabulary in this chapter. You can bet you're going to have to be able to identify what these tax systems are by a description. You should be able to define them. A proportional tax. Everybody pays the same fraction of their income, regardless of how big their income is. So this is saying everyone will pay 1%, 2%, 10%, 20%. No deductions in a proportional tax system. There's a regressive tax where high-income taxpayers end up paying a smaller fraction of their income than low-income taxpayers do. And I'm going to tweak some of you here and tell you that our total taxation system, all of the taxes that we pay, our total tax system in the United States is actually regressive. Our income tax is actually progressive, where the more you earn, you pay a larger percentage of your income than you do if you're low income. But when you look at the total tax system, when you include property taxes and consumption taxes, you end up with an actual regressive tax system. So in a regressive tax system, somebody earning $50,000 would pay 30% of their income, a $100,000 earner would pay 25%, and a $200,000 earner would pay 20%. The tax amount increases, but the percentage tax decreases. The proportional system says everybody pays the same percentage, which means that the tax burden increases as the income increases, but it's fixed percentage. And then you get the progressive tax system where the tax percentage increases as the income increases. So looking at these numbers, what is most fair? Where do we get the most equity? Where do we get the most efficiency? Okay, now our income tax system is progressive. Here's what it looks like. If you have taxable income from $0 to $8,375, your tax rate is 10%. It is incrementally increased over time. Politicians will adjust these dollar amounts. The rates generally remain unchanged, but they'll shift the dollar amounts around. In a few years, it might be $82,401 to $173,006. They change them around with some frequency based upon inflation rates, income growth, all sorts of different factors. Here's the interesting thing. If I earn $10,000, I pay 10% tax on the first $8,375. And on the next $1,625, I pay 15% tax. You don't pay the highest tax rate on all of your dollars. You just pay the highest tax rate on that portion of your dollars in that tax rate. If you did not understand what I just said, again, you have to go read the chapter. Horizontal equity is the belief that when taxpayers have similar abilities to pay, they should pay roughly the same amount. The difficult thing about trying to achieve horizontal equity is income the only determinant of ability to pay? Mr. Hoke and I don't have any kids. There's got to be a family in the universe somewhere who has the same income we do, who has 3 kids. Should we pay the same amount? Do we have the same ability to pay? Many people would say that Mr. Hoke and I, without children to support, have a greater ability to pay. And the question would be, who gets to measure that, determine that? How does all of that work? Okay, we're going to do some practice and then we'll wrap up today. Better write some of this down. So the income tax rate is 25%. The first $20,000 is not taxed, so your tax rate begins at $20,001. Married couples are the same as single couples. So Sam and Diane earn $50,000. If they're living together and are unmarried, what is their combined tax bill? Meaning, what would each of them pay individually and then add it together? And if they're married, what is their total tax bill? Okay. So if they're unmarried, Sam and Diane are each going to pay $7,500. 25% of their $50,000 income, except remember that first $20,000 isn't taxed, so it's 25% of $30,000 of income. So each one of them is going to pay $7,500. So total, they'll pay $15,000. Their joint income is $100,000. Remember, each one of them is earning $50,000. So unmarried, they're each paying 15% of their joint income. Now the second part of our scenario says if they're married, what do they pay? Their combined income is $100,000. We exempt the first $20,000, so they have $80,000 in taxable income. 25% of that is $20,000. So when married, they are paying 20% of their joint income. That $5,000 difference between shacking up Sam and Diane and in married bliss Sam and Diane is what we refer to as the marriage tax or the marriage penalty. And many people get very, very incensed about this. Let's do another one. So we'll set the tax rate at 25%. If you're single, the first $20,000 of your income is excluded from taxation. If you're married, it's $40,000 that gets excluded. Harry doesn't earn a dime. Sally earns $100,000. Okay, well, let's go with Harry's a stay-at-home dad. Okay, so same set of questions. If they're living together unmarried, what do they pay in total taxes? And if they are married, what do they pay in total taxes? So Harry is going to pay 0 in taxes. Sally is going to pay 25% of $80,000 because that first $20,000 isn't taxed. So she's going to pay $20,000. So their total taxable income is $20,000. Now, if they're married, remember the first $40,000 isn't taxable. So they're going to pay 25% of $60,000. They're going to pay 15% joint tax. And this tax system would create what's known as a marriage subsidy, and it encourages marriage. It is an incentive. Okay. I've had about half an hour lecture. You're going to have some free time here at the end of class. It will be quiet. No, you can't have a pass to go somewhere else. You have homework due tomorrow. I want you to do end of chapter problems 1, 2, and 3. And you're not going to be able to whip them out and hand them in here because you're going to have to do some research on the internet. And I'm going to guess that Mr. Boyd's on board with me saying, no, you can't whip out your phones and work on this now. This is going to be actual homework. Open your books. If you have not read, you need to read now.